So I'm delighted to have today Bob Newman, who's a managing director of Chatham Financial, which is one of the leaders in financial risk management, has been for, Bob, how long have you guys been around?
Ned, we're turning 30 this year.
Wow.
30 years old.
Wow. That must be quite an occasion.
I hope we'll have some celebrating. I think we will.
I'm sure you will. So we're going to get into a little more discussion about specifically the kinds of things that Bob does. But as a personal note, I've known Bob for over a decade. And one of the reasons why I think he's very valuable to bankers, particularly in the area of his specialty, which is interest rate protection, swaps, derivatives, is because he was a banker and spent a number of years, maybe more than you care to relay here, essentially doing the job of a lot of the people that you're now trying to help through various strategies. So give a little background about yourself, Bob.
Oh, thanks, Ned, and really appreciate you having me on here today. I grew up in a banking household. So my dad was a community banker in Connecticut. So as the oldest of 6 kids, he said, I want you off the payroll. So you need to go study economics in college and then find a bank training program who will pay you to learn. Then you can be a banker. Then from there, you can go and do whatever you want. So I left Connecticut in 1979, studied at William & Mary from 79 to 83. And it was an interesting time to be an econ student because in those same years, Paul Volcker had joined the Fed in 1979, and we had the double-digit inflation and unemployment, the misery index, and embarked on a monetary policy experiment to squeeze inflation out. So interest rates really shot up to unprecedented levels while I was tucked away, in that college classroom. So that was kind of a foreshadowing of what would come next. So I became a commercial bank trainee at Maryland National Bank in Baltimore, and made some loans, some good, some bad. They sent me back to the credit department for what I call remedial credit training. And while I was there, the bank had, I would say, a little ahead of its time for a regional bank outside of Wall Street, but the bank decided to start up an interest rate swap desk. And I was going to rotate out of credit, and I don't think they wanted me back on the lending side because of some of the loans I made. So I was asked to help start up an interest rate swap desk in 1988. So that's kind of how it all started. I veered off the, I would call the traditional banker career path, and have been unable to get away from interest rate derivatives ever since. So and joined Chatham after about 20 years in banking in 2003.
So give a little perspective briefly on Chatham, just for people who are not familiar with the organization.
Sure. So I mentioned we were founded in 1991, and our founder, who worked with one of the, what was then the money center banks in New York, Chemical Bank, was I would call a pioneer in the derivatives market, and really felt like I would say that the deck was stacked against a smaller user of hedging tools, and felt like there was an opportunity to cross the table and really align himself at the time as a one-person firm with smaller users of derivatives to bring transparency and to really demystify what is often seen as a very complicated instrument, useful, powerful, but maybe dangerous and complicated. So Chatham was really founded with that, I see a transparency, buyer's advocacy model, and then really grew in a lot of adjacent ways into different client types. And so we are, I'd say we're the largest independent partner in the derivatives and hedging space today.
Yeah. Well, I know that you deal with a lot of different industries. You're a specialist in financial institutions, and at last count, I think you told me you're working with over 200 financial institutions of all sizes on strategies that help them in different ways solidify relationships with commercial customers, help them manage their own exposure to interest rate risk management. What are some of the things, what are some of the things that you focus on with financial institutions?
Oh, sure. No, I think there really are a lot of, I'd say, applications and uses of the tool. I feel like, as a bank first decides to interact with swaps, it seems like it's the commercial lending side that kind of bubbles up the opportunity when a bank is trying to solve what I will often call the 10-year fixed rate loan dilemma, which I think is very familiar to bankers, where what does the borrower want? Well, the borrower wants the lowest rate. They want stability. They want a fixed rate, and they want that for as long as they can get. They also want, if they can have it, the ability to renegotiate if it benefits them. So they want all the flexibility. They want everything, right? The bank just wants a fair return. They want to win the loan. They don't want to lose the relationship, and have the ability to hopefully expand the relationship. So, finding a way, if you just start making a lot of those loans, you might end up with way too much interest rate risk. So, to me, the essence of a swap is this ability to trade places on the time spectrum. So a fixed rate can be synthetically converted to a floating rate. And there are different ways to apply the tool, but that's really, I would say, using a swap to compete and hopefully win more long-term fixed rate loans is one of the first applications that we see banks using. And then I think it kind of goes without saying that as the balance sheet of a bank is filled with interest rate sensitive items on both sides of assets and liabilities, and we have an asset liability management discipline that measures and quantifies what that risk profile looks like. A swap is really tailor made to also help a bank at that macro level, rather than turning on or off a spigot. Let's just, okay, we're full up. Let's not make any more fixed rate loans, or we have to go out and do long-term fixed rate CDs to match our fixed rate loans. To move beyond the realm of the physical asset and the physical liability, kind of get up above the balance sheet and then use a derivative to fine tune that risk profile, to tweak the sensitivity. So it's a great tool, down at the loan level. It's also a great tool, I'd say, up at that macro balance sheet hedging level.
Let's focus for a second on the commercial lender and the applications. Are there things that their customers don't know about interest rate protection? I mean, there's occasionally you'll see articles about the horrors of derivatives that have done irreparable damage to some entity. What is it that they don't typically know about these things?
No, that's a great question. I think, and swaps have been blamed and been given a black eye for a lot of things. I know some think that derivatives caused the financial crisis, as an example, where in reality, I think the housing market, there were some credit default swaps that triggered some of the AIG and then Lehman Brothers. But I guess I think the instrument itself isn't risky, but the application can be. So to your question, I think it's really incumbent upon a bank, if the bank's going to put a borrower into a derivative, to explain how that works. I think probably the aspect of an interest rate swap that can trip up a small, a local community borrower is the idea that it's essentially a fixed rate solution that comes with accountability. So kind of going back to the point from a minute ago, that the borrower wants to be able to do what I would call residential refi. I got a 5% deal. The market went to 4. I want to write my loan down from 5 to 4. If you use a swap to get a fixed rate, you can't do that any longer. So I think that's probably the biggest piece of the puzzle that gets misunderstood, is that you don't have, if you're using a swap, you no longer have the ability to basically do what I would call being a one-way floater. I think a lot of commercial lending, when prepayment penalties are negotiable or not even there, it's not really a fixed rate loan. I mean, it's a loan that's locked in today. It'll never go up, but if the borrower asks, the bank will mark it down. But when we're using swaps, I mean, fixed is fixed, and there's accountability, and I think that's where there's some misunderstandings.
Yeah. Well, we were talking earlier about the fact that a lot is changing. The last time we had seen inflation at the level that is being talked about was almost a dozen years ago. As you look into the near term, what should commercial lenders in community banks or in other financial institutions, what should they be thinking about when it comes to the interest rate situation of their customers? What should they be considering?
Well, I just think that the borrower will always want that predictability. I think that's sort of a given in the equation. The fact that we're sitting here, using the Fed's target, we're at 0. We're very, very low on interest rates. So the idea that inevitably we will go higher from here. It's just a matter of when does that start. I think from the community bank standpoint, you need to find a way to be able to accommodate the borrower's demand for that long-term fixed rate, especially because as competitive as the marketplace is, someone in your market will be doing that. So the idea that, hey, we're just going to do 5-year deals and we'll hope that the borrower will go for that is pretty much a thing of the past. So I think you need to find a way to accommodate. It doesn't necessarily have to involve putting a derivative, into the borrower's hand. So there are ways. I think if a bank just wants to make fixed rate loans, absorb the risk for a moment, but then think about a portfolio hedge. There's ways to really use this tool. And I think as I look at community banks, sometimes there's maybe a reluctance to take that swap to the portfolio level out of concerns of the accounting, for example, or I'm putting a swap on my books. The accounting rules have actually, they've been around for 20 years now, the FAS 133 and the derivative accounting that puts swaps on the balance sheet is famously complicated, or people perceive it as complicated, but the FASB really made derivative accounting much more user-friendly just 3 or 4 years ago. So the ability to actually lend fixed in a portfolio and then hedge that bucket of loans as a portfolio is now a very viable strategy, a very doable strategy. So it was once, pre-changes, and I'm going back to say pre-2018, it would have been very difficult to hedge a portfolio of fixed rate assets. But that's changed completely. And I would even say, we look in the second quarter, our clients who are doing balance sheet hedging, 9 out of 10 of the deals were done in portfolios of fixed rate assets. So some loans and some securities. So it's really become, I think, the most efficient way for banks to manage risk holistically is to do that at the portfolio level. So I'll stop there, but there's a way to actually meet that borrower demand without necessarily having to sell the swap as a product to the borrower.
Yeah. So that the term that you use, portfolio hedging, is essentially bundling together both loans and securities at the bank level.
Yeah, I think typically you would typically probably isolate. It would either be a bundle of loans or a bundle of securities. You'd probably have some like kindness in the portfolio, but some nitty gritty details to work out to get that done. But yes, it's not, as opposed to doing one fixed rate loan at a time, it's the idea of doing almost like a bucket of money on the balance sheet to go out and lend and be competitive.
Yeah. You and I have run across each other at conferences over the years, because I know you like to go to conferences and speak to people. We're Zooming today, but I suspect that if people are interested in learning more about any of the things that we've just touched on, one, they can expect to see you at conferences.
Yes, I'm looking forward to getting out of the house, Ned.
I think a lot of people, mostly our spouses, are saying that. The other way for people to get smarter about the kinds of things that might be relevant in terms of understanding derivatives broadly include, obviously, reading and checking sources. Chatham's got a lot of information. You've published a lot of things over the years about it. What's the best way for people to find you and the resources at Chatham?
Well, thanks. No, I mean, there's I think we now call it the insights section of our website. So there's lots of articles there. I've done some directly for bankdirector.com.
Mm-hmm.
And we try to do that really with a community bank in mind. So try to keep it in plain English, not a lot of high-level Wall Street technical calculus, but just the plain, I'd say, pragmatic application of the tool. You know, we'd like to think of, you know, how are these tools used to solve a problem? What are the problems that banks have, and how can these tools help them solve the problem?
Yeah, well, you've done a great job of that over the years. You're a tremendous resource. You're somebody that I know, based on the comments of a number of my clients, has been extremely valuable as they've tried to think through how to really serve their customers and serve their shareholders with intelligent risk management strategies. So kudos to you. Keep doing what you're doing. 30 years, Chatham Financial. You haven't been there all that long, but almost, right?
It's getting there, Ned. I'm coming up on 20 myself. So
well, it's a great career. Keep doing what you're doing. And I would encourage, again, anybody who wants to dig deeper into this topic to reach out directly to Bob. Bob, best email for you is?
bnewman@chathamfinancial.com.
All right. Well, thanks again, Bob. This has been it's been great fun. I appreciate your spending time with us today, and thank you for all you're doing for the industry.
My pleasure, and hope to see you out on the conference circuit as well, Ned.
Take care.
Take care.